Welcome to the Opening Bell Report.
Imagine checking your portfolio, right? You're minding your own business, maybe sipping your morning coffee, and you realize this AI brain stock just jumped 30% in one day.
Yeah, that's the kind of movement that makes you do a double take, for sure.
Exactly. And not over a month, not over a grueling quarter. One single trading session. Now, add some context to that, because that single day surge was really just the exclamation point on a cumulative weekly gain of over 100%.
Which is just wild when you look at the broader market.
Well, it really is. If you were watching the ticker symbol AIFF on March 6th, 2026, you saw exactly that play out. Firefly Neuroscience closed that day at $1.85. It capped off the kind of violent vertical market movement that it forces you to stop whatever you're doing and figure out what on earth is going on.
Right, because movements like that don't just happen in a vacuum.
They don't. And that is exactly our mission for this deep dive today. I'm your host, and joined as always by our resident expert. We are pulling all of our insights today from a single, highly detailed financial and technical analysis report on AIFF to really unpack the anatomy of this explosion.
We need to figure out if this is just, another flash-in-the-pan, retail-driven meme stock rally, or if we're actively witnessing a fundamental shift in AI healthcare happening right under our noses.
Right.
It's essentially the multi-million-dollar question. And to truly answer it, you have to understand what Firefly actually does, because they are not just another generic tech startup slapping the letters AI onto a pitch deck to get funding.
Which we see a lot of lately.
Oh, constantly. But Firefly operates in the highly complex space of brain health. Specifically, their core platform is called Brain Network Analytics, or BNA. What the analysis report lays out is that Firefly is taking standard routine EEG data, the traditional brainwave test that neurologists have been running for literally decades, and feeding it through NVIDIA-powered supercomputing.
So they're basically taking an old test and giving it a massive brain upgrade.
Exactly. They are translating those raw, chaotic electrical signals into highly actionable, objective clinical biomarkers. And they're targeting massive global health issues like depression, dementia, and ADHD. So they aren't inventing a new way to scan the brain. They're taking an established testing method and applying a level of computational processing to it that, frankly, simply wasn't possible a few years ago.
Which is why this is so relevant to you listening right now. If you've ever wondered what it actually looks like when massive computational big data collides with human biology, or how institutional investors spot a company right as it claws its way out of that dreaded zombie stock phase, this is the ultimate real-time case study. Okay, let's unpack this. We have to start with the history.
We do, yeah. Because a stock doesn't just casually double in a week without some serious trauma in the rearview mirror.
Exactly. According to the analysis report, Firefly hit the NASDAQ back in 2024 through a reverse merger with a company called Wavedancer. Now, for anyone following along who might not know, a reverse merger is essentially a faster way for a private company to go public by taking over an existing shell of a public company.
Right, it skips a lot of the traditional IPO headaches.
But post-merger, it was not a glorious climb at all. They went through what the financial world politely calls a value discovery phase.
Oh yeah, value discovery is definitely one of those great Wall Street euphemisms.
It really is.
In reality, it means the market looked at this newly merged entity, wasn't sure how to price the risk, and just aggressively sold it off to find the absolute bottom. The stock had a 52-week high of $6, but the selling pressure was relentless.
Just brutal.
By February 2026, it had completely collapsed, bottoming out at a meager 62 cents.
62 cents from $6.
Yeah. That 62-cent mark was the ultimate floor. That's the point where all the weak hands had completely folded. But then a dramatic structural shift occurred. If you look at the technical chart data from the report, the stock began mapping out a textbook V-bottom recovery.
And a V-bottom is exactly what it sounds like.
Exactly. Yeah. You can picture it perfectly. It's a steep, agonizing, multi-month drop to a sharp, definitive low point, followed by an immediate, aggressive, high-volume spike back upward. After lingering below that $1 mark, seemingly left for dead, it suddenly gapped up and completely shattered its 50-day moving average.
And it did so on record-breaking trading volume, which is really the key differentiator here. Volume is the ultimate lie detector in the market.
Absolutely. You can't fake volume.
You really can't. Now, for anyone tracking the momentum indicators on this breakout, the RSI, the Relative Strength Index, hit 72.8.
Yeah.
Usually when you see an RSI pushing past 70, you're looking at a stock that is running incredibly hot.
Very hot.
It means it's technically overbought in the very short term, and the buying has been so frantic that a brief cool down or maybe a period of sideways consolidation wouldn't be shocking at all. But you can't look at RSI in a vacuum. You have to pair it with the MACD, right?
You're exactly right. The RSI tells you the car is speeding, but the MACD, the moving average convergence divergence, that tells you if the engine itself has been upgraded.
I love that analogy.
Thanks. Yeah. The report highlights we saw a bullish MACD crossover, which happens when a shorter-term moving average aggressively crosses above a longer-term moving average. It is a massive flashing green signal for technical and algorithmic traders.
Oh, like a flare going up.
Exactly. It tells the market that what we are seeing is not just a random low-volume blip. The underlying baseline trend has fundamentally reversed to the upside.
And when a trend reverses that violently, it creates collateral damage. Let's talk about the squeeze dynamic here, because the share structure of AIFF is basically a powder keg.
Oh, without a doubt.
The public float, meaning the number of shares actually available to trade, is incredibly tight. It's sitting right around 12.5 million shares. Against that tiny float, the short interest is sitting at 2.94%. Now, on the surface, under 3% short interest might not sound like a massive number compared to some historical meme stocks we've seen. Right, it doesn't sound like GameStop numbers. Exactly. But the critical detail from the analysis report is that we recently saw a sudden 12.5% decrease in those short positions.
And that decrease is the footprint of a localized panic. When a tightly coiled stock with a small float suddenly jumps 30% in a single session, the people betting against it are suddenly underwater. And the math works against them exponentially.
They start scrambling?
Exactly. They are forced to step into the open market and buy shares at whatever the asking price is just to cover their positions and stop the bleeding. So you have this perfect storm of liquidity. You've got organic buyers rushing in because of a fundamental catalyst, algorithmic traders piling in because of that MACD crossover we talked about, and short sellers panic buying to close their bets.
And when you funnel all three of those massive buying pressures into a tiny 12.5 million share float, you get a 100% weekly gain.
Bingo.
Here's where it gets really interesting, though. Because all of this technical movement, the violent V-bottom, the record volume, the short covering it, wasn't spontaneous.
No, not at all.
There was a highly specific trigger. The specific catalyst was their March 4th announcement. And that announcement contained the single most powerful word in the current market ecosystem: NVIDIA.
Yeah, that word alone moves markets right now.
It does. Firefly announced they had successfully integrated NVIDIA-powered GPU acceleration for their brain models. The moment that news hit the wire, the stock reclaimed price levels it hadn't seen since late 2025.
What's fascinating here is the specific architecture they chose. Firefly is utilizing NVIDIA L40S GPUs. Now, for anyone outside of the enterprise hardware space, it is vital to understand that this is not just a routine IT upgrade.
Right. They didn't just buy a nice new laptop.
Exactly. You don't buy L40S architecture just to run your standard software a little faster. This specific massive computational infrastructure fundamentally transitions Firefly's corporate identity. They evolved overnight from being a simple localized test provider into a sprawling big data company.
Right, because previously their business model was essentially just providing these BNA tests to individual clinics. But with this new computing power, the analysis report notes they unlocked a staggering 33-fold increase in their scan volumes.
33-fold. That is massive.
It is. So why does that specific 33x volume jump matter so much to the overall valuation?
Because in the world of artificial intelligence, data is the only fuel that matters. If you don't have unique, proprietary, high-quality data, your AI algorithm is essentially a sports car without an engine. It looks great, but it goes nowhere.
Right, it's just an empty shell.
Exactly. By increasing their scan volumes 33-fold, Firefly is pulling in a massive daily influx of complex brainwave data from across their entire network. And because they now have the NVIDIA horsepower to actually process all of it simultaneously, they are using that data to build something completely unprecedented.
The foundation model.
Yes, the world's first AI-based foundation model of the human brain.
Let's map this foundation model concept to something you, the listener, probably use every day. Think about how a large language model like ChatGPT works. It had to ingest millions of books, articles, and websites just to understand the baseline of human language to know how words connect and what context means. Firefly is essentially doing that exact same thing. But instead of ingesting the written internet, they are ingesting millions of hours of chaotic electrical brainwave data.
That's a great way to look at it.
Right. They are training their AI to learn what a perfectly normal brain looks like.
Yeah.
So it can instantly recognize the subtle, early-stage deviations of a brain developing dementia or severe depression.
Precisely. And from a business standpoint, that creates what institutional investors call a defensive moat. If you are a competitor and you're watching Firefly's stock run, you can't just copy them. You might be able to raise some capital to build a sleeker physical EEG sensor, but you absolutely do not have the years of processed AI-trained proprietary data that Firefly is currently hoarding and analyzing.
You can't fake time in beta.
Exactly. The data itself, that massive, ever-growing foundation model, becomes their most valuable asset. It creates a nearly impenetrable barrier to entry for any traditional medical hardware company trying to pivot into their lane.
Okay, I love the vision. Building a foundation model of the brain is the exact kind of narrative that gets venture capitalists foaming at the mouth. But I want to play the skeptic for a second and peek under the financial hood.
Let's do it. The numbers are important.
Because if we look at the raw numbers from their Q3 2025 financials in the report, the reality check is pretty stark. The revenue for the quarter is just $388,000.
Which is tiny.
Right, for a company traded on the NASDAQ, that is a microscopic footprint. And the rest of the ledger is rough. They posted a negative $2.64 million operating income. The earnings per share, or EPS, is negative 20 cents. Their free cash flow is deeply negative at $1.5 million.
No.
And maybe the wildest metric to swallow their cash flow as a percentage of sales is negative 384%.
Yeah, that's a tough pill to swallow on the surface.
They are burning cash at a rate that would terrify a traditional value investor.
Look, if you look at those numbers through the lens of a mature, dividend-paying blue-chip stock, yes, they are terrifying. But if we connect this to the bigger picture, those numbers are incredibly typical, almost textbook, really, for an early-stage medtech company that is right in the messy middle of transitioning out of pure research and development and into commercial scaling.
It's growing pains, basically.
Exactly. You also have a return on equity of negative 340% and a return on assets of negative 61%, standard for this specific life cycle phase. In market valuation for emerging tech, the raw absolute numbers matter far less than the trajectory and the growth rate. Yes, $388K in revenue is modest, but it represents a staggering 1,075% year-over-year increase.
Over 1,000%. That's huge.
Think about the velocity of that trajectory. That kind of explosive percentage growth is exactly why the analyst consensus is shifting right now. They're officially upgrading the stock's classification from highly speculative to growth watch.
I see the trajectory, and over 1,000% growth is undeniably impressive.
Yeah.
But the analysis report notes they have a $4.3 million cash pile, giving them only 3/4 of runway. That is terrifyingly short in this market environment.
It's tight, definitely.
Their current ratio is 2.1, which implies they can cover their immediate obligations. But if they don't break that $2.16 technical resistance we mentioned and start attracting serious institutional money fast, aren't they just going to be forced to dilute their shareholders with another stock offering to keep the lights on?
It is the perpetual sword of Damocles for any. That is the genius of their recent corporate strategy. The drop in operating expenses is largely because they finally concluded the integration of a company they acquired called Evoke Neuroscience. This is a crucial piece of the puzzle.
Oh, interesting.
Instead of spending $50 million hiring an army of sales reps, flying them to every neurology clinic in the country, and trying to convince doctors to adopt a brand new ecosystem from scratch, Firefly bought Evoke. They acquired an existing, established clinical network.
So they bought the distribution channel instead of building it.
Precisely. So you have revenue exploding, expenses dropping by a third because the integration costs are off the books, and suddenly the path to a positive price-to-earnings ratio is actually visible. Now, currently, their PE remains negative at 0.56x, and their price-to-sales ratio is elevated at around 33x, but the market is a forward-looking mechanism. It is pricing in the direction those margins are heading.
Let's dig into that capital efficiency a bit more, because the overall valuation here is so unique. The market cap is incredibly small, sitting at just $26.3 million.
That tiny market cap is exactly why the retail side of the market is swarming it right now. To put that $26 million valuation into perspective, you have to look at their lead private competitor, a company called Ceribell.
What's their store?
Ceribell had to raise and burn through hundreds of millions of dollars of venture capital just to build out their physical hardware network from the ground up. By acquiring Evoke's infrastructure, Firefly is completely bypassing that massive capital burn. They are executing a commercial rollout at an absolute fraction of the capital cost that their competitors endured.
So mapping all of this out, what does it mean for the immediate future? Let's look at the forecast data from the analysis report. The stock closed the week at $1.85. The technical analysts map out that the stock is currently testing a massive multi-month resistance zone between $2 and $2.16.
That's a critical zone to watch.
Right. And the chart logic dictates that if they can get a sustained high-volume break above that $2.16 level, the next target is a rapid gap fill, pushing all the way toward $3.50. And for the remainder of 2026, assuming the commercial scaling holds up, analysts are suggesting a broader trading range between $2.18 and $4.23.
That's a pretty wide but very bullish range.
But we have to be clear-eyed here. There are no major institutional price targets issued yet. The big banks haven't chimed in. This entire surge so far is a retail-led momentum play.
It is retailed at this exact moment, yes. But retail momentum brings liquidity, and liquidity brings institutional eyeballs. The institutions won't buy based on a MACD crossover, they will buy based on the operational metrics. And the most critical operational metric for 2026 isn't the share price, it's the physical footprint of their user base.
The actual clinics using the tech.
Exactly. Right now, Firefly has a commercial user base of 99 sites. But that isn't just 99 software licenses sold. Those are 99 clinics and hospitals actively using the platform, representing a 1,880% growth trajectory.
And that clinical footprint is incredibly sticky. Once a hospital integrates a diagnostic tool into its daily workflow and trains its staff on it, they rarely rip it out. Plus, those 99 sites are actively feeding more patient data back into Firefly's foundation model, making the AI even smarter, which in turn makes the product more valuable to the next 99 sites they onboard. It is a compounding loop of value.
Exactly. As those 99 sites and the new ones they rapidly add continue to scale their daily use of the BNA platform, that initial 388 days in quarterly revenue is projected to accelerate exponentially.
So what's the final verdict from the analysis report?
The verdict from the data is very clear. This 30% jump was not a random meme rally. The market is finally waking up and pricing in operational velocity. Yes, the $26 million valuation is tiny, and yes, the cash runway is tight. But that 1,075% year-over-year sales growth is the ultimate proof of concept.
It proves people actually want this.
It unequivocally proves that the BNA technology actually works, and crucially, that medical professionals trusted enough to pay for it in a real-world clinical setting. AIFF has officially shed its zombie stock status and emerged as a legitimate commercial stage A healthcare contender.
So let's summarize the sheer scope of what we've walked through today. We took a single, highly detailed analysis report and used it to connect the dots on a truly wild market event. We watched a company go from a messy reverse merger down to a brutal capitulation level 62-cent bottom, only to completely reinvent its fundamental business model.
It's quite the turnaround story.
Driven by an aggressive NVIDIA-powered infrastructure upgrade, they transitioned from a basic clinical test provider into a sprawling, data-driven medtech platform, building a foundation model of the brain. They've narrowed their losses, leveraged an acquisition to drop their operating expenses by 35%, and posted over 1,000% revenue growth, proving their tech is actually being adopted.
And for anyone actively tracking this story, there is a very specific date you need to circle on your calendar.
Let's hear it.
The next earnings estimate is fast approaching on April 2nd, 2026. That upcoming earnings report will be the ultimate fundamental stress test. It will reveal if this operational momentum and user base growth is truly sustainable, or if that three-quarter cash runway is going to force their hand into a difficult capital raise. It is the definitive prove-it moment for the company.
Definitely a date to watch. Now, I want to leave you with a final thought to mull over as you go about your day. We spent a lot of time today in the weeds talking about moving averages, market caps, capital efficiency, and short squeezes. But I want you to step back and think about the core product sitting at the center of all this financial data.
The tech itself.
Yes. Firefly is building the first AI foundation model of the human brain. We are talking about taking the chaotic, entirely invisible electrical storms that happen inside our heads and turning them into perfectly readable, predictive, objective data points. If a company can successfully do that at a global scale, wait, no, not if when they do that. What happens when diagnosing incredibly complex, traditionally subjective conditions like early onset dementia or severe clinical depression becomes as instantaneous, routine, and irrefutable as running a simple blood test?
It changes everything.
It really does. How fundamentally will that alter the human experience of mental health and cognitive decline? It's a massive societal level question, and the answer is being built right now at the fascinating intersection of artificial intelligence and biology. Thank you so much for joining us on this deep dive. Keep asking questions, keep digging into the data, and we will catch you next time.
Don't forget to like, share, and subscribe for more.